Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka, where I will be decoding the cues for trade, all the stocks that will be in focus. And of course, we'll also be taking up all your stock-related queries with our technical expert on the show. So if you have any queries, keep them coming in on our live feed on YouTube. We'll try and take them up. Of course, lots to watch out for today. The GIFT Nifty is hinting at a mildly higher start for our market. Of course, the Nifty clocked in a fourth straight day of gains and the third record close in succession, right? So, of course, we'll be watching out for how we open up, given the fact that the global cues are fairly subdued this morning. Lots of stocks in focus, including the likes of Tata Motors. Of course, we'll be decoding as to what the master stroke of demerging CV and PV businesses mean for the shareholders. And of course, lots of other stocks to watch out for. So lots lined up over the next 30 to 35 minutes. Stay tuned with us. But let's take a look at the top headlines at this hour. Wall Street rally takes a pause as Nasdaq retreats from record levels ahead of Fed Chair Jerome Powell's testimony and the February jobs print later this week. Asia inches lower even as China sets a growth target of around 5% for 2024. The GIFT Nifty, however, is suggesting a flat start for the Indian market with a positive bias. Crude slips after OPEC Plus extends output cuts until June. Brent hovers around the $82 per barrel mark. Meanwhile, gold prices rise above the $2,100 per ounce mark to its highest level ever. And Bitcoin tops that $68,000 mark, closing in on its November 2021 high. Among stocks to watch out for, Tata Motors will split into two listed companies as board approves separating commercial vehicles business and passenger vehicle business as two separate entities. Meanwhile, RBI bars IIFL Finance from sanctioning gold loans with immediate effect after observing supervisory concerns. Let's quickly take a look at the cues for trade before we talk about Tata Motors. Well, the Nifty shut shop very flat yesterday, although we did inch higher and ended above the 22,400 mark for the first time ever. If you look at the India VIX, that cooled off a bit below that 15 level, 0.5% lower, so 14.9 is where the India VIX is at. If you look at the FNO cues, the Nifty OI open interest was down 1%, shedding 1.3 lakh shares. Nifty Feb futures at a premium of 92.35. points vis-a-vis 123.6 points premium. And when you look at the Nifty Bank index, right, the open interest was down 2.5% and it had shed 58,000 shares. And if you look at the put call ratio, that has dropped to 1.3 vis-a-vis 1.32. Z continues to be in FNO ban. And let's also take a look at the fund flow picture. FIs remain net sellers. They have sold shares worth 564 crore rupees in the cash market yesterday, whereas DIIs continue to remain buyers in the market, have bought in shares of shares worth rather 3,500 crore rupees or thereabouts in the cash market. But without any delay, let me bring on board Aditya Velekar of Axis Securities, joining in this morning to decode what the Tata Motors board's approval to demerge or split the CV and PV businesses into two separate listed entities really means for shareholders. Great to have you on the show, Aditya. Would you call it a master stroke by Tata Motors to really unlock value for shareholders?
Yeah, good morning and thanks for having me on the show. Yeah, so this is a smart move. So the demerger will unlock the value of the passenger vehicle business of Tata Motors, which has done really well on all the parameters recently, including their JLR business. And also we have seen a distinct performance between the CV and PV cycles recently. While the commercial vehicle cycle is showing signs of slowdown, the passenger vehicle cycle is going robust. And that is also reflected in the recent February numbers of both Tata Motors and Ashok Leyland, where the CV sales were down by 4% and 6% respectively. But on the other hand, the passenger vehicle segment has done well for Tata Motors, with its sales rising by 19% year-on-year in February. Against this backdrop, the demerger between the commercial vehicle and passenger vehicle looks rational. And we see this demerger as a strategically positive step, and it will help in better value discovery for both the businesses in future.
Right. What is the kind of value you'll be assigning to the CV business in particular, Aditya?
Yeah, on a valuation front, I think means Maruti, which is a leader for the CV business. If we see Ashok Leyland, which is a pure play CV player, it currently trades in the range of 10x its FY26 EBITDA. And we expect Street to ascribe a similar value to the CV business of Tata Motors, given the structure of the CV industry owing to its higher cyclical nature. So CV, we expect the Street to give a similar range as of Ashok Leyland, in the range of 10 to 11x its EV/EBITDA.
Right, and talking particularly about the stock, it has run up quite a bit. In fact, very close to that 1,000 rupee mark. Would you see a case for immediate re-rating of the stock post this move, Aditya?
I guess there might be some value unlock, especially in the passenger vehicle side of the business. So if you see Maruti, it trades at the EV/EBITDA of 16 to 17x, its 12-month forward EBITDA. And currently, Tata Motors passenger vehicle business, many analysts on the street, they value it below the Maruti's multiple. So if the demerger happens, then the unlocking will happen on the passenger vehicle side of the business, and we might see some upgrade, but that we have to see, and that time will tell how the value discovery happens. But there is a potential for upgrade from the passenger vehicle side, because the passenger vehicle business of Tata Motors has done really well. The debt at the JLR is coming down, and their electric vehicle portfolio, and their then the new launches, for example, the Tata Punch and all. So electric vehicle Tata Punch. So all these things will pan out, and that has given some confidence that the PV business may unlock, and we may see some value unlock there. So we see this demerger as a positive steps, and we may see some upgrades or some positive reaction from the market going ahead.
All right, expect positive reaction from the market going forward. Of course, this will be unlocking value, especially in the PV end of the business. With that, Aditya, thanks a lot for taking our time and joining in this morning and putting into perspective what this move really means for the shareholders. But let's also take a look at what brokerages have to say about Tata Motors, right? Post this news of the demerger. Morgan Stanley has an overweight rating, target price of 1,013 rupees. In fact, Morgan Stanley says that the demerger reflects confidence in the passenger vehicle business being self-sustaining, and it can, in fact, help in better value discovery for shareholders. JLR in India, passenger vehicle business will also have synergies in the electric vehicle era. JP Morgan also has an overweight rating, target price is 1,000 rupees per share. In fact, they also say that the demerger might lead to better value discovery, and necessary approvals could take further 12 to 15 months to complete. Investec has a hold rating, target price at 900 rupees per share, but they are saying that they do not really expect any significant value on, in fact, any significant impact on valuations as a result of the transaction. In fact, it will create a pure play CV and global PV play with respect to Tata Motors. Incred also, of course, taking a contrarian view here, they have a reduced call, target price at 639 rupees. And they also maintain that post-split, the valuation may favor the passenger vehicle end of the business, which commands a 62% of total valuation. Let me also bring on board, our technical expert for today. Joining me, Sacchitanand Uttekar of TradeBulls Securities. Great to have you on the show, Sacchitanand. Before we talk about the markets, want to do a chart check on Tata Motors as to where do you expect the stock to open today?
Good morning, Nandita, and thank you for having me on the show. Clearly, when we look at the chart structure, the stock has been in a very strong secular bull trend. But with an RSI value on its monthly and weekly scale above the 85-90 zone, I think it will be difficult for the momentum to sustain. And probably that's why it's better to look at the stock on a decline itself. If you look at the daily scale, we have been seeing a bullish pattern breakout, and the pattern breakout targets are almost concurring near to that 1,000 mark. So I don't see the stock scaling and sustaining above the same. Probably the stock is due for a corrective move. The immediate level to track on the lower side is standing at around 980. The moment this particular level is breached, we may see a good decline towards 950, 945 zone. I think that is the most important support zone from a weekly structure perspective. So I think it's better to wait for a decline and then get into a counter. On the higher side, we may see this particular stock, getting into a hurdle at around 1,000, wherein the profit booking could be very evident. So it's better to avoid chasing momentum and wait for a decline.
All right, wait for a decline to get into Tata Motors and avoid chasing momentum here. But let's talk about the indices as well, Sacchitanand. Third straight day of record close, although you can say that the euphoria clearly is missing, because whenever we hit a record high towards the end of the day or towards the midday, we turn very range bound and volatile, right? So here on, do you spot any bit of fatigue on the charts, especially in terms of benchmarks? And secondly, Nifty Bank, fourth straight day of gains, even though it has remained flattish in the last 2 to 3 sessions. But do you expect this uptrend to continue here on?
Well, Nandita, uptrend should continue until unless we don't see the Nifty, closing below that 22,000 mark. I think that is the immediate support that we are tracking in. If you look at the last week, we saw a very strong surge on Friday session, wherein the index, displayed a very confident closing above the 22,200 mark, where Nifty was struggling, to sustain. So I think the immediate support on the lower side is placed somewhere close to around 22,200. This is where even the option, writers are very confident. And on the higher side, the immediate hurdle is at around 22,500. So probably we may see Nifty, taking a pause and consolidate a bit before it resumes the next leg of the up move. So we may see a sideways action within this particular range. I think for the day, 22,285 could act as a very strong support. Any declines towards that particular support would be a good, healthy opportunity to create some long positions. But I think, again, here, chasing momentum should be avoided. 22,500 looks like an immediate hurdle. So probably we may see some range-bound action throughout this particular week within this particular range itself.
All right. And, talking about Nifty Bank, as I mentioned, fourth straight day of gains. Do you see more upside and, the index, in fact, defending that 47,000 mark? And secondly, I think, I want to just quickly take a query also, since it is on the banking space. Union Bank, how is that looking on the charts in particular? Pon Rajesh wants to know your thoughts on this one.
So Nifty Bank, definitely, the reward to risk opportunity is much more better as compared to Nifty. And even here, if you look at the data, 47,000 looks like a very confident base. So any declines towards 47,100, 47,170 should be utilized to create some long positions. On the way higher, we may see the Nifty Bank, outperforming, and probably we may see it scaling towards 48,000 earlier. So I think when it comes to both the indices, I think the reward to risk opportunity is far better in Nifty Bank. Also, if you look at some of its constituents, we have clearly seen that there has been a very strong positioning by ICICI Bank, which still continues its high top high bottom sequence. HDFC Bank has displayed some resilience. In fact, it has maintained its tail above that 1400 mark, which remains a very strong psychological support. And from here on, if you look at both these constituents, they are positioned for a good, strong rally. So I think the overall contribution for Nifty Bank would be led by these two main components, and that's why we believe that Nifty Bank is ready to outperform. When we look at a stock like Union Bank, probably we may see some bit of a consolidation here. On an immediate basis, it has been facing a lot of hurdle at around 150, 148 kind of a zone. And on the lower side, 140 remains a very crucial support. So probably we may see this stock consolidating within this particular range itself.
Right. With that, the markets have opened, of course, and we have we are having a soft start this morning, given the fact that the GIFT Nifty is also suggesting or had suggested a subdued start for the Indian market. But if you look at the Nifty, just about 50 points lower. Open. In fact, 22,350 is where it's at. Yesterday, remember, we had a record close at 22,400 and we had clocked a fourth straight day of gains and third straight record close for the Nifty. But of course, we have snapped out of this uptrend for a bit. Of course, some bit of profit taking happening at higher levels. Look at the Sensex down 200 points, 73,670 is where it's at right now. The mid-cap index also seeing some bit of a pressure. So 0.3% kind of downtick coming in on the mid-cap index. Let's pull up some of the sectoral indices as well. Looking at the Nifty Bank Index, that has also snapped out of a 4-day gaining streak. In fact, the Nifty Bank Index is down 0.5% this morning. Also, let's take a look at the auto pack. Post the news of Tata Motors demerging two of its arms, PV and CV businesses. Let's see what the auto index is doing. Of course, 0.5% uptick coming in there. I'm sure most of the gains must be driven by Tata Motors, because Tata Motors itself is the top Nifty gainer today, 2.5% up on the back of that particular news flow. Aside of that, if you look at M&M, that's also snapped out of its losing trend, and it's among the top Nifty gainers today, and so is Eicher Motors. So a couple of names from the auto pack are doing well today. But let's also take a look at the Nifty IT index, of course, right? Because CLSA has downgraded some of the large cap IT names, so that could have an impact, because TCS is among the top Nifty losers today, third top Nifty loser as we speak, and JSW Steel as well continues its downtrend from yesterday. CLSA had downgraded JSW Steel and Tata Steel yesterday, and that is clearly weighing in on the stock prices today as well. HCL Tech, another top Nifty loser on the back of that report from CLSA on the IT pack. Sun Pharma, Tata Steel, HDFC Bank, Reliance, these are some of the heavyweights that are on the losing end today. And aside of Tata Motors, if you look at the other gainers, NTPC extending its winning streak. You have UPL as well today on the gaining side, almost a % gain kind of gains coming in there. Bharti Airtel, Coal India, Apollo Hospitals has snapped out of its losing trend. It has been on a losing spree for quite a few sessions now. Just about trading in the green, slightly positive, no big gains coming in there. ITC, Bajaj Finance, Adani Ports, Bajaj Auto, these are some of the other movers. But Sacchitanand, I want to get in your thoughts on, an Infosys and TCS on the charts. As I mentioned, there has been a report from CLSA where they have downgraded TCL and HCL Tech to sell from underperform. Of course, we've seen that the IT pack has been stuck in a downtrend over the last few sessions. Do you expect the pressure to continue?
Yes, Nandita. In fact, we are of the opinion that there is a good amount of consolidation to corrective move which should be unfolding in Nifty IT. And within this particular space, we are confident about the chart setup of Tech Mahindra, wherein we see the stock scaling down towards 1220 or 1200 kind of a zone. So if you look at most of the constituents, they are displaying a bit of a weakness. TCS, it did show a good spurt in momentum last week, but the hurdle at around 4200 remains the important cluster of resistance. And on the lower side, 4000 remains as a dependable support. So probably TCS is one of the stocks that can be avoided from a sell perspective. We may see more of a range-bound action there. But when it comes to Infosys, there has been a negative crossover on its short-term averages, plus its RSI on the lower side has breached below the 50 mark, and it has also breached below the consolidation support at around 1700. So I think the low top low bottom sequence or the bearish sequence should continue here. The immediate support that we are tracking on the lower side is around 1600. So probably we may see Infosys continuing its negative trend. Keep a stop loss somewhere close to around 1670 on a closing basis, and fresh short positions can be considered for a 1600 target.
Right, that's the view on the IT pack. But the other stock that I really want to talk to you about is IIFL Finance, right? Let's pull up the charts of IIFL Finance and see the kind of knee-jerk reaction that we are seeing on the stock as a result of the RBI's order. Putting an immediate ban on sanction and disbursal of gold loans. Now, gold loans forms 32% of the AUM for IIFL Finance. But although the RBI has said that the company can service existing gold loan portfolio through collection and recovery processes, but of course, this has come as a big setback, and of course, the management has also, reacted to it. They've said that they will be, of course, complying with RBI norms and ensuring that things are in place. But of course, knee-jerk reaction on the stock. On the charts, how much more of a downside can one really expect?
This is the first, gap down that we have seen on the stock. It was, trying to sustain about that 560, 580 kind of a cluster support zone. So this is the first time wherein this particular cluster support has been breached. So definitely Going forward, the same level at around 560 would act as a very stiff resistance. And on the lower side, the next meaningful support is placed somewhere close to around 410, where its 200 weekly exponential moving average support is also placed. So we may see this trend getting extended. Uh, Somewhere close to around 410, 420 would be an ideal zone to review positions.
All right, that's the view then. Aside of that, let's talk about a Manappuram Finance as well. We have a query coming in from Rajesh Veera on this particular stock. Here, what are the kind of stop losses one should keep in mind?
So even from a trading perspective, I think this is a good candidate wherein the stock seems to have displayed a very confident breakout above that 185 cluster resistance. The gap of opening, itself is reconfirming the momentum strength, and we may see this particular momentum getting extended towards 210. Positionally, we are expecting a price target somewhere close to around 224. And that's why I think momentum longs can be built in here up to 193. The stop loss for the trade should be placed at around 188. On an immediate basis, we may see the level of around 200 getting achieved today. But from a momentum perspective, expect this particular rally to continue towards 210.
All right, that's the view on Manappuram Finance. Rajesh, hope that answers your query. But the other query is coming in from Ashutosh Namdev, and he wants to know your thoughts on a BHEL as to whether it makes a good or it is a good time to invest in this particular stock. BHEL, of course, today it's cooling off a bit. Yesterday, it hit an 8-year high, right? 13 to 14% kind of gains we saw in yesterday's session. Would you advise, Ashutosh, to wait for a further dip before getting in?
Well, first of all, if you look at the monthly chart structure, the long-term structure, it is still indicating that there is enough room on the upside, which is yet to be, which can be seen over the period of few months. But on an immediate basis, we may see the stock, displaying some consolidation to a corrective. So the immediate support that he should keep in mind is around 245. Any declines towards the same would be a good opportunity. On the higher side, we have already seen a good strong 10 years breakout at around the 200 levels, and the pattern target is still indicating a price up move towards 310. So probably the reward to risk would not be that healthy, but it is better to accumulate this particular counter on a decline. From a trend strength perspective, it is important that the stock maintains its closing above 230 zone. So I think the stop loss can be placed there on a week-on-week closing basis. And on a decline up to 240, 245, I think that will be an ideal level wherein some longs can be considered.
Right, that's the view. Hope that answers your query. But the next query is coming in on an RVNL, and this one is coming in from Gomthi Muruga. She wants to know your thoughts on RVNL. Of course, some of the railway counters have cooled off quite a bit over the last 1 month. Although, of course, on a 6-month basis, we've seen a very strong rally across the railway pack, right? But the recent downtrend, should that be bought into?
So I think this is a good accumulation zone right up to 220. Any further declines could be a good opportunity here. But as of now, the major trend still remains positive. 205 is an important, support zone from a trend perspective. So until that holds, the buy on decline strategy would be healthy. And recently, we have seen even the declining momentum getting stalled. So probably this is a good time within this range of around 240, 45 on the higher side to 225. I think the stock can be accumulated.
All right, that's the view on an RVNL. But lastly, one of the queries that are that's coming in is on Paytm from Satya CK. He wants to know whether the weakness that we are seeing in this particular counter should be bought into with a 1 to 3 year perspective. Would you advise anyone to jump in right now, or would you say it's a clear avoid?
Nandita, it still remains an avoid. Even at the level of around 900, we were indicating the same. Even on a decline, we have maintained our stance, and even right now, I think the trend is far more clearer. So we don't expect an immediate turnaround in this particular stock. The price trend is still, displaying a good amount of weakness. Eventually, we may see the stock, scaling towards 280, 85 kind of a zone. So that will be a good level wherein, we may review this counter. But as of now, it's a clear lower top, lower bottom sequence, and buy on decline strategy may not be healthy.
All right, that's the view on Paytm. It's a clear avoid. With that, hold that thought, Sacchitanand. We'll come back and take up more viewer queries. But let me also bring on board our next guest for today. Joining me is Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth. Great to have you on the show as usual, Feroze. I want to ask you, headline indices, of course, are perched at record levels, right? But that euphoria clearly is missing, at least when it comes to the headline indices. But at the same time, we had a Sebi Advisory coming in recently where, the market regulator has, cautioned about the froth building up in the mid-cap space, the euphoria, so to say. So here on, do you think mid and small cap funds will see outflows? And, if yes, should one with, lesser or lower risk appetite move to large cap funds now? How would you really read into the entire Sebi Advisory?
Yes. Good morning, Nandita. It's nice to be on your show. Point one, like you said, there's 3-4 questions intertwined into one. What is Sebi saying? Sebi is saying that try and slow down the inflows into small cap funds largely. Because this influx of money, I don't think the Indian capital markets have so much research and depth and free float to be able to absorb the kind of money Indian households can put in. Indian households have 740 lakh crores and only 24 lakh crores of individual households is there in mutual funds. So the influx kind of money which can come from Indian households could be really large, and the capital market may not be currently prepared, and it requires an evolution to happen. That's point one. Point two, if you look at 34 stocks which have tripled in this financial year from the top 600, you would see 28 stocks out of these 34 had reasonable amount of shareholding increase from mutual funds. If you look at the one of the largest ones, I'm just giving you an example for illustrative purposes, no indication of the stock. Zomato mutual funds have added 52 crore shares in this financial year, and the market cap has moved from 41,000 to wherever it is, 1.5 lakh crore. So this kind of influx which can come from Indian households through domestic institutions can result in large movements in specific stocks. Then 28 out of 34 have had influx from the mutual fund industry, and they've tripled in a specific financial year. So I think that correlation must have been highlighted, or Sebi would have noticed this kind of correlation, is why that advisory. So, and I think as a mutual fund investor, which I am, I feel very confident that the regulator wants lower volatility in the future and is not just getting excited that Indians are investing. They want a pleasant experience over long periods of time for a new investor. And that's where the advisory's positive genesis comes from. And I think there's one more thing, Nandita. They've also changed NSE, in my opinion. They've not given the new methodology. NSE 500 has moved from total market cap method to organized stocks in its 500 stocks to free float. It's not just AMCs which Sebi is writing to. I think exchanges are also being consulted, and free float becoming a more important barometer for its weightage in the index.
Right. Further to this, how can mutual funds really ensure that investors who redeem first, don't put investors who are staying back at risk?
Yes, that's a very, very important question. One thing which I'm very, very intrigued or very curious, not intrigued, to see what kind of responses asset management companies give to this point number 2 from the letter of AMFI, saying that the first mover advantage should be curtailed. I think can create a sentiment damage, because if there's an investor 2 years back, he's invested into a small cap fund with a hope and a certain rule of the game that he will be able to access his money in 2-3 days time. Any rule change midway creates a larger dent to the sentiment. And that, if were to be done, that there are exit loads imposed or any restriction for that matter, or a perceived restriction also, creates certain degree of panic, saying that why am I not able to access my money? And then everybody actually wants to access the money. And there could be some degree of, not a run on the fund, but yeah, a little degree of something to that effect in a very small quantum. That's what I'm very, very curious to see.
Right. I want to get in your thoughts on certain sectors and pockets in the market, that one can look at the current juncture, right? IT, for one, post the third quarter numbers and management commentary, Street was factoring in, the worst may be over for, in terms of revenue growth, right? But of course, this morning we've had a report from CLSA wherein they've said that, growth for 2024 looks weak at best. And, it's not reflected in valuations as well. What are your thoughts on IT? I think you were pretty constructive in this space. Would you still remain constructive, or would you concur with what CLSA has to say? Because, I'll tell you why I'm asking this question. Because, of course, the rate cut in the US may have been further delayed to June now. But if that doesn't happen even in June, then things could look a little more bleak for the IT companies, right?
Yes, Nandita, you're absolutely right. From a short-term perspective, a couple of quarters here or there, or 1-2 quarters being written off in a sector is something so business as usual. If somebody is going to take a sector call, especially using a mutual fund platform, if at all one does it, I think it's more going to be from a perspective of a little long-term, at least 12, 14, 15 quarters. When you're looking at a structural change in an industry, you will have to be patient over the first 1, 2, 3 quarters. Of course, I called out IT in June last year. Because there was a sign of bottoming out on bad results. If the stocks start moving up, that's a reasonably good barometer to see whether the stock is oversold. But if you look at IT, I think IT is to be played from a perspective of it being the second largest sector in Nifty. And when you're looking at the buoyancy in these sectors, if India is going to get money, and which it is, both on the domestic side and the foreign side, there is going to be buoyancy. You at 22,400 levels and 22, 23 Ps of Nifty, I would also look at saving my capital when I'm running into an election. So point one is what kind of buoyancy comes because of the influx of money into the country and domestic side. I think IT fares beautifully in terms of the correlation between their buoyancy with respect to flows. I think in the short term, you will not lose too much money on the large stocks of IT. And in the long run, I think we are moving to innovation rather than just generic work in the IT space.
Right, another pocket that has been in focus is the entire hospital space, right? Of course, healthcare is seen as a structural play, right? But, of course, we've had, Supreme Court saying that, there should be standard rates that should be applicable across public as well as private hospitals. And, one section of the street has actually gone ahead and said that, this could be a killer for hospital stocks, right? Another section maintains that it's not an easy move to bring about, right? So most of them are viewing this, the downtrend that we've seen in hospital stocks as a buying opportunity. Would you concur with that? Would you say that, the weakness that we are seeing, the sentimental impact that we've seen on the hospital stocks is actually disguised as an opportunity to buy?
I think so, because what happens is, of course, regulatory changes can have impact, but I think a hospital has reasonably important levers and quite a few technical levers to maneuver that kind of regulation. And I'm sure if you look at a country like ours, where you're looking at medical inflation shooting up significantly more than double digit, I think that's the play. The inflation is not normal inflation. If you look at FMCG inflation and hospitalization inflation, especially in the upper strata where hospitals cater to, I think that inflation is what you're going to pay. That is going to give a revenue increase. And when we had actually computed, it turned out to be 13% a few years back. I've not done the full math today. So a few years back, 2-3 years back, and pre-COVID, a study showed that 13-14% is the inflation in sophisticated medical care. And Indian HNI is going to get the best medical care. And I think it's a buying opportunity if you're going to play the inflation story. And of course, regulation is a dent which you can buy into from a long-term standpoint.
Among the industrials also, I want to get your thoughts on cement, right? Volume tailwind was there, but pricing tailwind was missing, right? And that is expected to, stay the case in the coming quarter as well. I think you've maintained that cement is a good 6 to 8 month kind of a play. Would you concur with that?
Yes, see, I would certainly concur with that, because the kind of infrastructure spending which is still there in the pipeline, and the kind of commitment, if the government continues, any infrastructure and other adjacent businesses are going to do beautifully well. So I would definitely concur. Of course, the valuations from a historical average standpoint are almost about 2 standard deviation higher. If you look at long-term mean PEs, and PE as a reasonable barometer for evaluation, I think they're marginally more valued. But if you look at the kind of fiscal spending which government has done in the first 9 months, it is significantly lower than what has been over the long-term story. I think I would still concur that cement has some place in the portfolio. And I think whenever you look at sector, you do plus or minus how much it is there in Nifty. I think it should be overweight relative to the Nifty weightage.
All right, that's the view then on the cement pack. But with that, I'm afraid we are running out of time. Feroze, I want to thank you for taking out time and joining in this morning and sharing your thoughts with us. Always appreciate you joining us in the morning. And of course, I look forward to having a longer conversation with you pretty soon.
Pleasure.
All right, let's go back to Sacchitanand then, who's been waiting by quite patiently. Sacchitanand, a number of queries have trickled in since the last query that we took. Rupak Mehta wants to know your thoughts on AAS Financiers, right? He's, I think he already has some holding, and he's losing somewhere around 5% on his investment. He wants to know, in fact, whether he should stay invested and wait for a turnaround. What would you advise him to do?
Nandita, we have, I think, addressed this particular stock a couple of times on your show, and clearly, the trend on this particular stock remains weak. We are of the opinion that the stock may, scale lower towards around 1200 levels. So as of now, even if you look at some of the, trend indicators, they are not displaying any, change, anticipated change. So probably we may see, this price action on the lower side getting extended. So it's better to avoid averaging in this particular counter and wait for a decisive price pattern reversal. So which is not evident even at this juncture. So probably he can delay his investments.
All right, that's the view. I hope that answers your query. I want to get in your thoughts on a Gensol. Prashant Sampath wants to know your thoughts on Gensol. Today, I think it's up 5%. Over the last 5 sessions, we've seen some bit of profit taking, or so to say, because it's down 15% if you look at the last 5-day movement. But here on, given today's recovery, would you look at levels on the higher side here?
Well, the volume action is not that convincing. We have already seen the stock, displaying a correction from the recent life high at around 1376. So, we may see a pullback, but the volumes are not that convincing. So I would rather avoid, advising any long position there.
Right, that's the view then. But I think I would like to take a last query on RCF. This one is coming in from Sukruta. She wants to know your thoughts on this particular stock. Last 1 month, we've seen the stock shed quite a lot of weight, right? 14%. But for somebody who has some bit of holdings in this particular stock, should they, wait it out, book some loss? How would you look at this one?
Well, RCF, I think now the stock is close to its demand zone. 140, 145 looks like a decent support wherein the stock can be accumulated. On the lower side, major turnaround or a pattern failure will only unfold in case if the stock starts trending below 132 levels. So I think keeping a stop loss on a weekly basis at around 132, the stock can be accumulated. We may see, a few months of consolidation here, but overall the trend structure is still healthy. There is no major change when it comes to its long-term structure. We may see this particular stock stabilizing here, and probably once the uptrend resumes, again the stock may head higher towards 185, 190 kind of zone. So it's a good zone wherein the stock can be accumulated.
All right. Well, that's the view on RCF. But this wraps up our query segment. But Sacchitanand, anything you're spotting on the charts for the next couple of sessions?
So, Nandita, I think what we have shared with your team is Reliance Industries is looking positive. We have seen a good strong breakout above the 3,000 mark. It has been sustaining well. A fair bit of consolidation here, and the stock can be accumulated. Keep a stop loss somewhere close to around 305 on the lower side. And on the higher side, we may see this rally getting extended towards 3070. So this is a long trade from my end. On the short side, IIFL Motors had displayed a breakdown from a consolidation band. If you look at the daily chart structure, there's a falling tree formation, again a continuation pattern on the daily scale, reconfirming the weakness. We see the stock falling towards its 200-day exponential moving average, which is placed somewhere close to around 3650. So trading short positions are recommended here. Keep a stop loss somewhere close to around 3830, and review your position somewhere close to around 3650.
All right, RIL and IIFL Motors, two recommendations coming in from Sacchitanand. With that, Sacchitanand, as usual, thanks a lot for taking our time and joining in and sharing your thoughts and, of course, addressing all our viewer queries so patiently. Have a good day.
Thank you, ma'am.
Well, with that, of course, before I wrap for the day, in fact, I want to just take a look at the new listings, two new listings at 10 a.m. today. Of course, Exicom Tele is likely to, see a blockbuster debut. In fact, we had a pretty healthy subscription figure. The IPO was subscribed 130 times the shares on offer, and there was a very strong demand coming in from non-institutional investors as well as retail investors. Of course, watch out for that one at 10 a.m. Also, Platinum Industries will be listing on the bourses today, and it is also expected to command a premium of somewhere around 50% to its issue price. So these are the two new listings to watch out for at 10 a.m. But with that, we are completely timed out on this edition of Opening Bell. I want to thank all of you for tuning in. Of course, if you have any comments to make, any feedback to share, leave them in the comment section below. Of course, keep following us on all our social media handles as well. And of course, you guys stay tuned to Money Control for all your other news and updates through the day.